Why I don't invest in international stocks. Simple. It's losing its relevance. The diversification for international across the borders is losing its relevance. The reason I'm doing the scare quotes is because I'm going to share with you an article I just read from my man Dave Blanchett over at, he used to be Morningstar, and he's not Morningstar anymore. It's from Advisor Perspectives. Where is he working for? I think it's an insurance company now. Let's see. Managing Director of DC Solutions for QMA, which is part of Prudential. All right, yeah, so big fan, long time, first time. Anyway, a big fan of Blanchett. To just cut to a chase, here's the level of diversification. All right, so we got correlation to average returns, and from international markets to, I mean, look at this. The correlation is going up significantly. You're not getting the diversification you used to get in terms of the free lunch that everyone talks about. So correlation to the global index have increased considerably as the dispersion has declined. In 1920, the average correlation was 0.46, less than one half, with a standard deviation of 26. This has been a significant change since then. For example, in 1975, the average correlation was 0.61 with a standard deviation of 18. Recently, the correlation has increased to an average of 88 with a standard deviation of 0.06. In other words, while the international investing has some diversification benefits, those have declined significantly over time. So I just want to share with this here. Domicile is typically a binary attribute. I'm not bi, or whatever is a bi. I'm not binary. The false dichotomy of the red versus blue, international versus domestic. But there is something that's, you know what I'm talking about when it comes to being binary. I can't believe we're so, I can't believe it. All right. Domicile is typically a binary attribute where a company is attributed entirely to a single location, i.e. country. But other metrics should be considered when defining the internationalness of a company. In this article, I explored the role of foreign revenue based on my research that was recently published in the Journal for Portfolio Management. The findings include the diversification of benefits of international investing has declined significantly over time. A key reason is the increasingly interconnected global economy. This highlights the weakness of defining geographic risk based entirely on a company's location. There was notable differences in foreign revenue exposure across countries and funds. While approximately 40% of the revenues of the U.S. domiciled companies is foreign. Did you hear that? 40% of revenues of U.S. domiciled companies is foreign, is much higher, 75% in the UK, and lower, 8% in China. Well, because China's commie. So you're relying on China. This is why I don't touch China with a 10-foot pole. 8% is revenues foreign. That's it, which means it's, a lot of people say, well, it just shows they're growing internally. It's all based on debt, man. It's just like any commie country, it's doomed to fail. All right. Suggests that the economic benefits associated with investing in the country may be lower than suggested by domicile-based metrics, that investors interested in obtaining a pure exposure to region would be better served from revenue-based strategies. Revenue exposure explained a meaningful level of variation in excess returns and excess risk among domestic mutual funds. This suggests that foreign revenue needs to be considered when assessing the risk of a fund, and that ignoring foreign revenue is akin to ignoring the size and value dimensions of a U.S. equity fund from a risk factor perspective. Overall, domicile proved an incomplete perspective on global risk and other metrics like revenue should be considered when defining the international of an investment or portfolio. All right. So again, you can see that this is, I mean, look at that. Just as we're going from, what did we say, 0.26 to 0.88. I mean, that's not 100% correlation, but it's pretty doggone close, man. And then we come down here. Notable differences of levels of foreign revenue across countries. I just want to show you something. Australia, 46%. Canada, 54%. Denmark, Finland, France, Germany, 89, 82, 82, 70. Why would you invest in UK or Europe stocks? Look at that. 89, 82, 82, 78. Doesn't make any sense. Whereas UK, 78. Switzerland, 93. Sweden, 81. Spain, 65. I mean, so why even bother with a European stock? I don't get it. India is only 33. China is only 8, but I don't trust them. South Korea, 55. Mexico, The Netherlands, 91. So all the European countries are all heavily, essentially tied to the West, i.e. U.S., probably a little bit of Canada. All right, so while approximately 40% of revenues for U.S. domiciled companies are foreign, it's higher in the UK, 78%. And look at Netherlands, 91% is all based on the good old US of A. Because the US of A, my friends, is the freaking, it is, what did Reggie Jackson say? The spoon that stirs the drink. It's us, baby. USA in your face. And so, look, you invest in S&P 500 total stock index. 40% of the revenue you're getting is coming from domestic or foreign companies, foreign countries. That seems fine to me. You make your choice, but the free lunch of diversification simply isn't there anymore. I will see you.